Here's my list of some of the best Vanguard index funds that you can buy this year, and there's even more to choose from when compared to last year. So without making things any more complicated than they need to be, I'll run you through all of them, explain what each of them are, and give you all of the information that you need to be able to make the right choice. Starting from the top, let's zoom out and go global. This is the FTSE All-World ETF, which is one of Vanguard's most popular funds for investors. As the name suggests, it's a fund that has stocks inside of it from all over the world. So that means that when you invest in something like this, you get all of the big names from the US, Europe, and here in the UK. In total, there are more than 3,600 companies inside of this fund. The ongoing fees are 0.22%, and it's passive like all of the funds I'm talking about here, meaning that everything is nice and simple because the companies inside are organised by their size. Now, just quickly, going back to the fees, 0.22% is considered a pretty low fee, and this is already baked into the fund. Now, that's an annual number, so just as an example, say you had £10,000 invested, 0.22% fee would mean that during a year, £22 would be removed from the value of your stocks. Divide that by 12, and that's less than £2 a month to buy almost the entire global stock market, which doesn't sound too bad to me. Now, here's something that's new for this year and wanted to highlight for you. This fund comes in two versions, and you'll see this a couple of times during this video. Up here, you have two options. One says accumulation and the other says income. Now, all this means is that one of these will pay out dividends and the other will reinvest them automatically. I think you can guess which is which. Now, why would you choose one or the other? Well, you might choose the income version if you were investing for the income. Maybe you're in retirement and you want some income to spend, or you prefer to take the dividends and then reinvest them yourself. Now, personally for me, I'd always choose the accumulation version. It's much simpler to manage. You don't have to go into your account every few months and check how much cash you get paid. And there's no worry about saving up enough dividends to buy a whole share. So just to be clear, here's the ticker symbol you need to look out for to buy each one. It's VWRL for the income version and VWRP for the accumulation version. You can find these index funds on any good investing app or platform. Just for reference, I'll show you them here on two apps that I use personally, Trading 212 and InvestEngine. And also, if you do want to get yourself started investing, I always leave the latest offers in the description below where you can get yourself some free shares or free cash just for signing up. Okay, let's move on to option number 2, the FTSE Global All Cap Index Fund. This is also a global index fund, but there are a couple of differences compared to the first one that we've just looked at. Firstly, this also includes some smaller companies, and you'll notice that there are more than 7,000 stocks inside of this fund. And secondly, probably more importantly, this is a mutual fund, not an exchange-traded fund. Now, I'm not going to go into too much detail in this video about the differences, but just be aware that a mutual fund will only be available on certain platforms, and you won't find this on apps like Trading 212 and InvestEngine. Also, as an added benefit, a mutual fund can be invested in with almost any amount of money, and you don't buy it in shares. So, for example, if you have £200 to invest each month, you could buy a fund like this and you will get exactly £200 worth of the fund. Compare that to an ETF where you might own 2 shares worth £90 each, but then you get some spare change left afterwards. Anyway, let's not get too hung up on the details. I do have loads of other videos on the channel going over stuff like this. Now, I wanted to highlight this one as I personally have my pension invested here, and one of my stocks and shares ISA on Vanguard is 100% in this fund. It's nice and simple, set and forget with low fees, and again, just like all of these options, it's completely passive, so you just leave the market to deal with itself. Now, I really like this one because, as I said earlier, you get to own stocks from all over the world, and this gives you a huge amount of diversification, which is one of the key foundations when it comes to being a smart investor. Being diversified across the world means that if one part of the world does badly, you don't lose everything, as another part can make up for it, and you get growth no matter where it comes from. After all, we have no idea what part of the world will do well this year, next year, or 10 years from now. By the way, if you ever want to find out more information on any of these funds, the Vanguard website here is pretty useful. To see what's inside a fund, you just go to this tab here that says Portfolio Data, and you'll see all of the stats like how many companies are inside the fund, all the pricing ratios, which part of the world the companies are based in, the sectors the companies work in, and then finally the list of all of the companies sorted by their market cap. And no surprises, you'll probably keep seeing the same names as you might imagine, like Apple, Microsoft, Amazon, and all of the rest of your household names. And for me, this is a good reminder that when investing, this is real money and real companies we're talking about here, and not just some abstract idea. So that's pretty cool that when you invest, you are owning a really small slice of these huge companies. Okay, zooming in now to fund number 3. This wouldn't be an index fund video if we didn't talk about the single most popular index in the world, the S&P 500. This is your benchmark of the best companies in the world, headquartered in the US, and has the reputation of being a market that is extremely difficult to beat. This is because if you had invested into an index fund that tracked the S&P 500 and put, say, £10,000 in 20 years ago, your investment today would be worth over £60,000. And that's through a pandemic, a global financial crash, and the end of the dot-com bubble. Not bad at all. As you can see, there are just over 500 stocks listed, and the fees are an incredibly low 0.07%, meaning that a £10,000 investment will only cost you £7 per year to manage. You can barely get a takeaway for that kind of money now, so count yourself lucky. Again, like the first fund, we now have 2 options on Vanguard's website that you can buy, one that pays you the dividends and ones that automatically reinvest them. Bear in mind also that you can buy this on any other platform as well. Remember, just look out for those ticker symbols, which we'll touch on in just a moment. Last year, you could only buy the option that paid a dividend, this one, VUSA, but now finally, you can buy VUAG, which reinvests its income for you on Vanguard's platform. Saying that, VUAG and VUSA have been available on all other good investment apps and platforms already, and I do actually own VUAG on my InvestEngine account, which I do regular monthly portfolio updates on. Don't forget to follow along and subscribe so you don't miss a video. And if you are finding the video useful, please do hit the like button for me. It will help get this video out to a lot more people who are looking to get invested just like you. Now, many investors consider this index to be the best of the best, and Warren Buffett himself has been quoted many times telling people that they'll be much better off just putting their money into an index fund like this, keep buying no matter what, and over many decades, they'll end up doing pretty well. Unfortunately, as much as this is great advice, many people will keep ignoring it because apparently people listening to Warren Buffett all think they can pick stocks just as good as him. But anyway, not much we can do about that. Okay, with that one done, let me go through some more interesting funds that you might want to look at or mix and match with. This one is the FTSE Developed World ETF. Now, as the name suggests, this is a fund that will invest in loads of stocks all around the world, but it will leave out the countries and companies which sit in the emerging markets. So you'll still be getting more than 2,100 stocks, but they will only be from the US, Europe, Japan, the UK, and parts of Asia. I said only. I mean, that's still a huge amount of stocks. Now, it's not a fund with low fees, as you can see here, just 0.12%. And it's all passive again, so there's nothing to manage, and the companies will change inside of the fund as they get bigger and smaller. Again, we now have an updated version of the fund as well on the Vanguard site, so you have both an accumulation version and an income version. The income version can be found if you search VEVE, and the accumulation version is VHVG. So if you type that into your favorite investing app, you'll see those, and you can make a decision that's right for you. Some of you might even think this fund on its own could be all you really need, as really, it's got most of the world inside of it already, and it's slightly cheaper than the global fund. The only thing you might want to add to this fund would be emerging markets, which we'll talk about in a moment. But for some perspective, if you break down the world stock market into developed and emerging, the entire emerging market only makes up around 10% of the whole market. So really, you could argue that 90% of the market is covered and you don't really need to worry about the rest. But then you could also argue that missing out on emerging markets could be a big mistake, as places like China could grow quicker than the US and Europe over the next few decades. But hey, there's no way of knowing that, so it's completely up to you how you want to invest. As always, this is just for some inspiration for you and to find what works for you, as I'm not your financial advisor. Okay, moving on as I hinted just then, let's now look at the FTSE Emerging Markets ETF. The clue is in the name, what area of the world this fund will invest in. It's got over 2,100 stocks inside of it and a low fee of just 0.22% per year. Just in case you weren't sure, let me show you what the emerging markets are. It includes companies from the following countries, as you can see here: China, India, Taiwan, Brazil, and many others. Parts of the world with very fast growing populations, some very big companies, but just a little bit behind when it comes to infrastructure and development. However, this doesn't mean that there can't be plenty of opportunities to invest here. That's all up to you, as I said earlier. But do just be careful, as the emerging markets are only just a very small part of what you can own when it comes to global stocks. I'd personally not go all in here in the same way as I wouldn't go all in on only UK stocks, because I think that would be a portfolio that's way too concentrated. And as we said before, diversification is the name of the game when it comes to investing. Unless you like losing money, then this might not be the right channel for you. Anyway, two versions here again. Just like last year, they only had the income version, which paid you a dividend, but now you also have the access to the accumulation version. As I said earlier, personally, as someone who wants to grow their wealth, I stick to the accumulation versions, especially if I was using Vanguard's platform directly. But if you are using a platform like Trading 212 or InvestEngine, you can invest in fractional shares and reinvest cash quite easily, so it does matter a bit less. As always, the decision is yours, but I do get this question asked a lot on the channel, asking what the difference is between the two kinds of funds, as people see these everywhere. Okay, last but not least, here's one that stays popular with many of you out there and makes the list again this year. Vanguard's FTSE High Dividend Yield ETF. This fund has 1,800 stocks inside of it, an ongoing fee of 0.29%. And this fund is a bit of a weird one, as yes, it's still technically passive, but the companies they invest in are filtered to ones that pay a reliable dividend each year. So rather than seeing the usual suspects in this fund like Apple, Amazon and Microsoft, instead you'll see the major players like JP Morgan, Exxon and Broadcom. Now these companies focus a lot more of their efforts on delivering dividends rather than just going all out on growth. So this means that if you own this fund, you'll get dividend payments 4 times a year. So once every 3 months, you'll get a payment into your account. And let's just run a quick example to show you some rough numbers. If you did say have £10,000 in this fund, we can see that the yield is 3.48% at the moment. So that means on an annual basis, you'll be getting around £348. If you ever want to see the amounts of dividends paid out, you can go to this section here and it will show you how much is paid out each time. Just bear in mind here that with dividends, there's no guarantee that they have to get paid by any company in the world, and the amount can vary in any given year. However, you are diversified here between a lot of different companies, so this should help if some of them stop paying or even reduce their payments in any given quarter of the year. Also, I've done videos on this part, but do be careful with dividend investing, as this money isn't some kind of magic free cash. Anytime a dividend is paid, that money is removed from the business, so the stock price also falls alongside it. But even saying that, a fund like this could be a good option for you if you were looking to get some income rather than just grow your wealth and not take anything from it. Funny enough as well, this fund now also comes in an accumulation version, so it has all of the same stocks in it, but instead of paying you that dividend, it will just reinvest them back into the companies. Seems a little weird for me to do that, but I suppose now you just be betting that these style of companies work out better than the rest of the market. And in certain times, you could be right, especially like we saw back in 2022. Those old dividend-paying companies did pretty well as the other growth stocks or non-profit making companies all crashed. So there you have it, my pick of some of the best index funds you can buy from Vanguard. All of the funds are available on different platforms, as I said earlier, so please don't forget to check out my links below if you want to get yourself started investing. Now, if you're still a bit confused as what to do now and you're brand new to investing, you might enjoy this next video to help you along. See you in the next video, and as always, happy investing.